The projector hummed in the dark of the boardroom, illuminating a single row on a spreadsheet that should not have existed. On the 3rd of June, 2017, inside a conference room on the 3rd floor of Disney's Burbank headquarters, a group of executives looked at that row and saw a number that contradicted everything they believed about their company. The film had not been released yet. The budget had been approved. The marketing campaign was running. And yet the internal projections already showed a loss so deep that it would take 6 consecutive hits to erase it. The projector hummed, and no one spoke. The surface cause was handed to the press 3 weeks later. The director had gone over budget. The script had been rewritten 7 times. The star had demanded changes that delayed principal photography by 4 months. These were the facts that the board offered to the public, to the shareholders, to the analysts. A failed movie, a star director, a budget that spun out of control. This was the story they told themselves. And this was the story they expected everyone to believe. But here is where it gets worse. The board knew, before a single scene was shot, that the film was in trouble. They had the data. They had the warnings. They chose to ignore them. What did they not see? That is the first loop, and it is worth holding open for a moment, because the answer is not what you expect. The board did not fail because they lacked information. They failed because the information contradicted their model of how blockbusters are made. Disney's internal model, refined over decades of franchise engineering, assumed that a film with a proven property, a top-tier director, and a guaranteed release calendar would generate a return of at least 2.5 times its budget. That was the formula. That was the law. When the early projections suggested the film would earn less than 1.2 times its budget, the model was not questioned. The model was trusted. The data was adjusted. The numbers were massaged until they fit the assumption. This is not a guess. This is documented in Disney's own internal strategy review, leaked anonymously to the press in 2018, which stated plainly that the board overruled the quantitative team's warnings 3 separate times. One executive, whose name has never been publicly confirmed, sent a memo in November of 2016. The memo was 6 pages long. It contained a detailed breakdown of the director's recent track record, a market analysis of audience fatigue with the franchise genre, and a projection of the film's probable return. The memo was circulated, acknowledged, and ignored. The executive wrote, in the final paragraph, a sentence that would later be described as prophetic in the post-mortem analysis. "We are betting on a formula that worked 10 years ago, against a market that has already shifted." The board's response was a single sentence in the minutes of the meeting. Noted. Proceed as planned. Think about what that meant for the executives, for the board, for the quants and strategists who had spent months building the case against the project. They had data. They had evidence. They had a history of successes followed by a growing cluster of failures. But they were inside an institution whose operating principle was that the formula could not fail. And when the formula begins to break, the institution does not question the formula. It questions the people who question the formula. The executive who sent the memo was reassigned 6 months later to a division that had no input on major creative decisions. The quantitative team was restructured. The culture of silence grew 1 layer deeper. The meeting in June of 2017 was not the first time a board had looked at a number it could not explain, but it was the first time the board looked at that number and made a decision that would cost the company nearly $200 million. The film's final budget, including marketing and distribution, reached $260 million. Its global box office gross was $143 million. The net loss was $117 million. That number is not a projection. That number is the reality that landed on the board's spreadsheet 18 months later. And yet, when the numbers were final, the board asked the same question they had asked in June of 2017. How did this happen? The answer was already in the room. The answer was in the memo. The answer was in the model that no one questioned. The first loop closes here, but the second loop is already open. Why did the board persist in a losing decision when the evidence was right in front of them? You have felt this. If you have ever watched a project you knew was failing, continue forward, funded, and approved. While your own warnings gathered dust in someone's inbox, you know the cold knot of frustration that the executive felt in November of 2016. The institution does not fail because it is incompetent. The institution fails because its operating model is designed to protect itself from the very information that could save it. The board did not see the loss coming because the loss was invisible inside their framework. A film that costs $200 million and grosses $143 million is not a failure of creativity. It is a failure of process. And process failures are invisible to the people inside the process. The board could not see the $117 million hole because their framework was built to reward confidence, not question it. That same blindness operates in markets every day. The pattern you spotted but could not prove. The trade everyone else called obvious right before it broke. Subscribe if you want to keep catching these invisible process failures before the crowd does. Then drop the word invisible in the comments if you have watched a losing decision. Keep moving forward while the data scream the opposite. Consider the gap between what the board expected and what actually happened. The board expected that the formula would produce a hit. They expected that the director's track record would carry the project. They expected that the franchise recognition would guarantee opening weekend numbers. What actually happened was a director who had not directed a live-action film in 6 years, a script that had been rewritten so many times that the original narrative arc was unrecognizable, and a franchise that had already exhausted its core audience. The projections versus outcomes comparison is staggering. The board's internal projection from March of 2017 estimated a global gross of $600 million. The actual gross was $143 million. The margin of error was $457 million. That is not a miscalculation. That is an epistemological failure. Now introduce the human counterpoint. The executive who sent the memo was not a disgruntled employee. She was a 12-year veteran of the strategy division with a track record of accurate projections. She had correctly predicted the underperformance of 2 earlier franchise films that the board had considered safe bets. She had data. She had methodology. She had a reputation. When the memo was ignored, she did not resign. She did not fight. She documented. She recorded the meeting minutes. She saved the emails. She built a paper trail that would later become the core of the post-mortem analysis. The second loop opens here. Why did she persist in documenting a failure she could not prevent? The answer is not heroism. The answer is institutional memory. She knew that the same pattern would repeat. She knew that the only way to break the cycle was to make the evidence irrefutable. She knew that the board would eventually ask how, and she wanted the answer to be undeniable. The psychological inversion that it explains both the board's blindness and the insider's insistence is the same. The board believed that more creative control means better product. The insider believed that less governance means better art. Both were right, both were wrong. The board's model treated the director as a variable to be managed. The insider's model treated the director as a resource to be trusted. The failure was not in the model. The failure was in the assumption that one model could apply to every project. The board applied the same formula to a director who had not worked in the format for 6 years. The insider warned that the formula would not work. The board proceeded anyway. The model was the problem. The model was protected. The flop was not a creative failure. It was a structural failure. The post-mortem, written by Disney's own strategy team and leaked to the press in 2019, stated the conclusion directly. The project was not greenlit because it was viable. It was greenlit because the approval process could not distinguish between a high-confidence project and a high-profile one. This is the paradox confirmed by the institution's own analysis. The board was not making decisions based on data. It was making decisions based on status, the director's reputation, the franchise's history, the board's own fear of being the one to kill a promising project. These factors outweighed every quantitative projection in the room. The loss was not an accident. It was a system output. Why did a company that built the most successful entertainment machine in history kill its own innovation? The answer is in the structure. The innovation was not in the film. The innovation was in the process that the board refused to use. The memo that was ignored contained a method for evaluating projects that accounted for market shifts, audience fatigue, and director unreadiness. That method was never implemented. The board did not learn. The market moved. And the machine continued to produce losses until the next board finally asked the question the previous board had avoided. What is the board's job if not to see what everyone else can see? The identity question lingers. The executive who wrote the memo left Disney in 2018. She works for a competing studio now, where her methods are part of the greenlight process. The board that ignored her memo is gone. The market that the board failed to see has shifted again, and the machine continues, because the machine is not the building or the people or the brand. The machine is the assumption that the formula will work forever, and that assumption is still alive in boardrooms across the industry, in meetings where the data says one thing and the status says another. The projector hums, the number glows, and someone in the room knows the truth. The question is whether they will speak. The boardroom on the third floor remained unchanged for years after that meeting. The same beige walls, the same oak table, the same projector that had hummed through the loss of $117 million. And inside that room, the same pattern repeated across 5 more projects over the next 3 years. Each time the projections were adjusted. Each time the warnings were noted and ignored. Each time the board looked at the data and saw what they wanted to see. The second film in that sequence was a sequel to a franchise that had already declined 40% in box office over 2 installments. The internal analysis, dated March 2018, showed that audience interest had dropped below the threshold required for a profitable release. The board approved the budget anyway. The justification recorded in the meeting minutes was that the franchise's international appeal would compensate for domestic losses. International grosses came in 22% below the most conservative estimate. The total loss on that project was $68 million. A third project was approved against the recommendation of every quantitative division. This one was a live-action adaptation of a property that had been dormant for 34 years. The target demographic had aged out of the market. The younger demographic had no emotional connection to the source material. The board's rationale, documented in a leaked strategy memo, was that nostalgia would bridge the gap. The film grossed $31 million on a budget of $180 million. The loss was $149 million before marketing cost. You just watched a board burn through $334 million because they kept trusting nostalgia over data. That pattern, the same mistake, the same justification, the same denial, is not unique to Hollywood. It plays out in every market where human ego outranks quantitative evidence. Subscribe if you want to keep seeing behind the curtain of institutional failure, because this story does not end with 3 films. And drop quantitative veto in the comments if you have watched your own organization make the same predictable mistake. At this point, the pattern becomes impossible to ignore. The same board, the same process, the same result. And yet each failure was treated as an isolated event. Each post-mortem identified the same cause: over-reliance on brand recognition, insufficient market testing, failure to incorporate quantitative warnings. Each post-mortem recommended the same solution: restructure the green light process to include a quantitative veto, and each recommendation was filed and forgotten before the next project cycle began. The institution was learning, but the learning was not translating into action. The knowledge existed in documents and spreadsheets in the files of executives who had been reassigned or had left. The institution was accumulating evidence of its own dysfunction without the capacity to use it. Here is the detail that changes everything. In 2019, a junior analyst in the strategy division ran a regression on all major Disney releases over the previous decade. The analysis revealed that the board's green light process had a predictive accuracy of 49%, barely better than a coin flip. The analyst presented the finding in a 15-minute meeting. The board listened. The board acknowledged the data, and then the board approved a budget for a project that the regression had identified as a high-risk property. The project lost $82 million. The analyst left the company 6 months later. The self-recognition moment arrives here. You have seen this. You have watched an organization ignore its own data, repeat its own mistakes, and blame everyone but itself for the outcomes. You have felt the frustration of watching someone make a decision that every indicator says is wrong, and knowing that your warnings will be treated as noise. The boardroom is not unique to Disney. It is the same boardroom in every institution where the formula is more trusted than the data. The projector hums in different cities, in different industries, in different languages. But the number on the screen is always the same: a loss that should not exist, generated by a process that refuses to see itself. The psychological barrier that prevents the board from learning is not incompetence, it is identity. The board defines itself as the group that makes correct decisions at scale. To acknowledge that the green light process is fundamentally flawed would require the board to acknowledge that its own existence as a decision-making body is suspect. This is not a rational calculation. It is an emotional defense mechanism wired into the structure of group decision-making. The board protects its own legitimacy by rejecting information that would undermine it. The data is real. The data is documented. The data is ignored. The analyst who left in 2019 did not disappear. He joined a smaller studio that had no franchise legacy and no boardroom formula to protect. Within 18 months, his team developed a green light process that incorporated quantitative veto points, market fatigue indices, and a mandatory cooling period for any project where the internal confidence score fell below 65%. The studio released 3 films in 2021. All 3 were profitable. None of them were franchise properties. None of them had star directors. None of them cost more than $40 million. The formula that Disney's board had trusted for decades was not the only path to profitability. It was not even the most reliable one. It was simply the one they had always used. The pattern is recursive, and it deepens with each iteration. In 2020, Disney's streaming division requested a budget increase of $1.2 billion to compete with Netflix's content pipeline. The quantitative team produced a model showing that audience acquisition costs had risen 40% year over year, and that the incremental subscriber value of new content had declined by 23% since the previous quarter. The board approved the budget increase anyway. The rationale being stated in the meeting summary was that market share required aggressive investment and that the model did not account for long-term brand effects. 2 years later, the streaming division reported an operating loss of $1.5 billion. The board's response was not to question the green light process. The board's response was to replace the head of the quantitative team. The replacement of the quantitative team leader is not a minor detail. It is the mechanism by which the institution preserves its operating model. When the data contradicts the formula, the institution does not update the formula. It removes the people who produce the data. This is not malice. This is structural inertia. The board does not fire the quant because they dislike the message. The board fires the quant because the message threatens the coherence of the group. The group cannot function if its members believe the formula is broken. The cost of preserving the formula is measured in billions of dollars. The cost of acknowledging the formula's failure is measured in the collapse of the board's identity. The institution chooses the cheaper cost every time. Consider the executive who wrote the memo in November of 2016. Her documentation was not an act of defiance. It was an act of preservation. She knew that the board would not listen. She knew that the same pattern would repeat, and she knew that the only way to eventually break the cycle was to create a record so complete, so irrefutable, that the board could not deny it when the next loss arrived. She was building a weapon that could only be used after the damage was done. That is the tragedy of institutional whistleblowing. The evidence is only seen as credible when the failure is already irreversible. The memo was prophetic. Its prophecy was useless because the institution was designed to ignore prophecies. The second loop closes here, but the implications expand. The executive left Disney in 2018. Her methods are now part of the green light process at a competing studio. The board that ignored her memo has been replaced by a new board that inherited the same structure, the same assumptions, and the same projector. The question is not whether the new board will repeat the mistakes of the old board. The question is whether any board, sitting in a room with a spreadsheet that contradicts its model, can do anything other than adjust the numbers until the model is satisfied. The evidence from the following 3 years suggests that the answer is no. The losses continued. The warnings were ignored. The quant team was restructured again. The machine continued to run on the same fuel. There is one more layer worth examining. In 2021, a researcher at a university business school published a paper analyzing the decision-making patterns of major studio boards over a 15-year period. The study covered 237 projects across 6 studios. The finding was stark. Boards that used a formal quantitative green light process with a mandatory veto threshold lost, on average, 22% less money on underperforming projects than boards that used the traditional consensus-based approval model. But this finding had a catch. The study also found that the boards using the quantitative process were more likely to override it when the project had high-profile talent attached. The quantitative veto was exercised in only 31% of cases where it was triggered. The rest were overridden by group consensus. The institution's own safety mechanism was routinely bypassed because the social cost of vetoing a star director was higher than the financial risk of the project failing. The projector is still humming. It is humming in boardrooms that have not yet learned the lesson, in institutions that have replaced their people but not their assumptions, in meetings where the model says no and the room says yes. The question at the end is not about Disney. It is about every organization that has ever looked at a number that did not make sense and chosen to trust the room instead of the spreadsheet. The answer is always the same. The formula will work until it does not. And when it stops, the board will ask the same question they have always asked. How did this happen? The evidence was there. The evidence was ignored. And the machine moves on, intact, unchanged, waiting for the next loss. The executive who wrote the memo left a trace that the new board has not yet examined. In the months after her departure, she compiled a document that mapped every major greenlight decision at Disney over a 12-year period, color-coded by outcome, and annotated with the quantitative warnings that had preceded each failure. The document was 214 pages long. It contained 703 individual data points. She sent it to the board's general counsel in August of 2018 with a cover note that read, "This is not an accusation. This is a reference. The pattern will repeat without intervention." The board acknowledged receipt. The document was filed in a drawer. The pattern repeated. The next project to fail under the same assumptions was a mid-budget drama with a critically acclaimed director and a script that had been in development for 8 years. The quantitative team's projection showed a high probability of a modest return, below the threshold that the board's own guidelines had established for approval. The board approved the budget anyway. The director's reputation was too strong to reject. The project's cultural significance was too important to ignore. The film was released in 2022 to critical praise and a global box office of $38 million against a budget of $75 million. The loss was $37 million. The pattern had repeated exactly as the document had predicted. 214 pages, 703 individual data points, a cover note that named the pattern before it repeated. This is not an isolated case. It is the architecture of how institutions fail, and it operates the same way inside markets, inside funds, inside every system that prioritizes comfort over evidence. If you want to see how these patterns get broken, not just documented, subscribe, because what comes next is the mechanism that forces the data into the decision loop. And in the comments, tell me one warning sign you have seen repeated that nobody acted on, and whether you ended up on the winning or losing side of that silence. The structure of the institution is not designed to absorb this information. It is designed to reject it. The board does not lack access to data. The board lacks access to the mechanism that would force the data to be heard. The quantitative warnings exist in reports, in memos, in regression analyses that are presented, acknowledged, and filed. The warnings do not exist in the decision loop itself because the decision loop was built around consensus, not evidence. The evidence is produced on paper. The decision is made in conversation. The two never meet. The post-mortem that was leaked in 2019 contained a recommendation that was never implemented. It called for the creation of a separate review committee, independent of the board, with the authority to veto any project that failed the quantitative threshold. The committee would have no creative input. It would have no financial stake. It would exist solely to say no when the evidence said no. The recommendation was rejected on the grounds that it would slow down the greenlight process and undermine the board's authority. The speed of the process was preserved. The authority of the board was protected. The losses continued. The last film in the sequence of failures was the most instructive of all. It was a project that the quantitative team had flagged as high risk across all 12 of their standard indicators. The director had not had a hit in 9 years. The franchise had declined 47% across the previous 2 installments. The target demographic had shifted to streaming platforms that the film would not be released on for another 6 months. The internal confidence score was 31%. The board approved the budget. The film was released. The global box office was $74 million against a budget of $200 million. The loss was $126 million. The confidence score had been exactly right. The cost of ignoring the quantitative warnings across these 5 projects was not measured in millions. It was measured in the systematic erosion of the institution's ability to learn. Each override of the data weakened the feedback loop that would have corrected the process. Each failure was attributed to external factors, market shifts, audience fatigue, streaming disruption, that were treated as unpredictable rather than as patterns that had been documented years in advance. The institution was not unlucky. The institution was designed to convert predictable failures into apparent surprises. The analyst who ran the regression in 2019 was invited to speak at an industry conference the following year. He presented the same finding that the board had heard and ignored. The green light process was barely more accurate than chance. The audience included executives from 6 major studios. 4 of them approached him afterward to request a copy of his analysis. None of them implemented the recommendations. The cost of restructuring the process was higher than the cost of absorbing the losses. The math was known. The math was accepted. The machine continued. The executive who documented the 12-year pattern has not returned to the industry. She consults now for smaller production companies that do not have boardrooms or projectors or formulas to protect. Her clients win more often than they lose, not because they are smarter, but because they are smaller. They can afford to be wrong on a single project without risking the survival of the institution. They can also afford to listen to the data when the data contradicts their instincts. The scale that protects Disney from competition is the same scale that protects Disney from its own learning. The institution is too large to fail and too large to change. The projector in that 3rd-floor room in Burbank may be gone by now. The room may have been renovated, the board may have been replaced, but the structure remains. The green light process has not been fundamentally altered. The quantitative veto has not been implemented. The memo that predicted the loss has not been reread. The losses that follow will be treated as surprises, investigated in post-mortems, attributed to external factors, and repeated in the next cycle. The institution has made its choice. It has chosen the formula over the data. It has chosen speed over accuracy. It has chosen itself over its own evidence, and that is the cost of building a machine that cannot hear the one voice that tells it the truth.